All right, well, welcome and good afternoon. Welcome to this CFA Society New Zealand webinar. My name's Alister Van der Maas. I'm the Managing Director of Russell Investments in New Zealand. I've been a CFA member since 2001. I received my charter when I was working in the UK. Since I returned to New Zealand in 2006, I've been a member of the CFA Society New Zealand. I'd like to welcome all the CFA charter holders, the associate members, members of INFINs and their guests, and anyone else who's listening to the webinar today. I think we've got a great session ahead of us today. It's going to be a little bit different from a probably traditional webinar. Today I'm joined by Andrew Bascand, Sharon Zollner and Rob Campbell, and we want to talk about the dislocation between what's happening in the economy and the financial markets. So I'm going to start right into it. We've got quite a lot to cover today. If you want to ask questions, there is a Q&A. I'll try and manage those as we go through the session today. Ask questions of those people. Be great if you could put your name down for the Q&A, so we can actually just say, you know, Bob from Goldman Sachs called and wanted to ask a few questions of Andrew. Without further ado, we're going to start with Sharon. So Sharon, starting up, frame the situation for us from an economic context. What's going on? What's happened in the last few months? What are you seeing in the New Zealand and global economies?
All right, thank you. I will just share my screen here, which has not gone into a... There we go. Excellent. I just have a very few slides because I know we're a bit short on time. A few lowlights, if you like. There's not too many highlights out there at the moment. But I guess essentially the main message is that we are, well, first, we've done good. We beat back COVID. We're the envy of the world. And our lockdown measures are easing much more rapidly than elsewhere and more completely than most other countries too. And that's fantastic. People aren't scared to go to hospital and get their immunisations and their cancer treatment and all the awful stuff that's happening overseas. And people are not afraid to walk down the street. But whether they will feel comfortable walking into a shop and spending money is a completely different question. So there's essentially two things going on. There's the lockdown disruption, which is now ending. And so we're getting a bounce in activity back towards more normal levels. And then there's the recession, which is only just starting. Essentially, the one tiny restriction that's left on our economy is rather a whopper, and that is the closed border. So international tourism is worth probably 5% of GDP by the time you take some of its spillover effects into the likes of retail and hospitality into account. That means the new baseline for the economy is 5% smaller. That's a horrendous recession in and of itself. And then, of course, you can layer over that the balance sheet damage done by the lockdown and the usual feed-through loops you get from the economy, from spending to retail to jobs to housing to back to spending, and round we all go. That we all know how those things work. So just a couple of measures out of the Business Outlook survey. We had another preliminary result out today, actually, that's not on this chart, but it showed a little bit more of a bounce. But basically, the main economic indicators, whether you're looking at employment or profitability or own activity, investment intentions, export intentions, all these things are off their lows, but they are still lower than they were at the worst of the recession after the global financial crisis. So we're enjoying the bounce, and there's this big collective sigh of relief, but there's still a lot of wariness out there. We have a new question, a backward-looking question in our survey asking about current staff numbers, and essentially 51% of firms are saying they already have fewer staff. On the other hand, some have more. But that's a pretty large number. That's versus a year earlier. Retail minus 56% net. So more than 56% have cut staff. And we're seeing stories like that in the newspaper every day. So we just have to be a bit realistic that the spending power, incomes in this economy are a lot lower, and that will feed through. So the tourism, yeah, it's directly, the international is directly 3%, but obviously the spillover effects are quite large. So you've got the international tourism is just under half, about the same size as domestic tourism. Domestic tourism is also going to take a hit, of course. It's a holiday in Queenstown is a highly discretionary item. In terms of market share, Australia is about a quarter. Of course, if they have nowhere else to go, we would expect our market share to improve. But on the other hand, Australia is also going to be experiencing a pretty nasty recession. Their household debt is even higher than ours. Ours is where it was in 2007, and we had about a 4-year recession in consumption, really. So we can expect that again. But then the unemployment rate peaked at 7. We see it peaking around 10 this time. And the issue there is that tourism, retail, hospitality, and construction are all really people-centric industries. So if we had a GDP hit from a drought, and the grass didn't grow and the cows didn't get fat, that's a much smaller hit to employment than if you're talking about tourism and retail and hospitality. But yeah, so
just pause you there for a second. The slides aren't showing for us. It's the main PowerPoint slide that you've got. So if you have been flicking through the slides, we haven't been able to see them.
Okay, thank you for that. I will just fix that. Just a moment, sorry. Okay, we'll do this again. There. Okay. Yeah. Okay. So yeah, thanks for the heads up. So can I go back to the previous one? Now it's ignoring me. Oh, there we go. Okay, so that was the profitability and employment intentions. You can see there's a bounce back, and it's bounced back a bit more, but the levels are still dreadful. And there you get a couple of pie charts. So the light blue is the international tourism, a bit under half. And then you've got the domestic about the same size, plus the orange is business. And down the bottom, Australia is the light blue. And the orange there is Oceania. So if we opened up to the Pacific Islands, it would be not quite, but largely one-way traffic. So that's not going to really save our tourism industry, but it would be quite nice for them. Some of them, tourism is 30% of their economies. So the Trans-Tasman bubble is the big hope, but Australia has not had the same success in beating COVID that we have. They're still experiencing double-digit cases on many days, particularly in Victoria, but also in New South Wales. So, and of course, lockdowns are a one-way street, really, politically, very, very difficult to go backwards. And so it's pretty unclear if they're going to manage to achieve what we have. And if they don't, it's pretty unclear how we're going to open that bubble safely. So still a lot of question marks around that, I suggest, because you don't want to jeopardize 95% of your economy in order to throw a lifeline to 5% of it. So our forecasts, basically, you can see the huge shutdown in GDP there, but then a very partial bounce back. So while under level 1, ostensibly all economic activity is possible, that's rapidly giving way to the question of what economic activity people will choose to undertake. And as I mentioned, that 5% hole in our economy is very, very large. And we unfortunately need people to move, to change professions, retrain, and that's quite slow. So the unemployment rate in the bottom right there rises very sharply, but then declines slowly. Huge uncertainty around that, but the wage subsidy will be masking some of it, and saving some jobs, but in some cases simply deferring unemployment. House prices, we see them falling 10 to 15%. That sounds like a lot, but they were up nearly 10% in the last year. And relatively few people would be in a negative equity position there. But nonetheless, it does make renovations and property investment and building new houses and all that sort of stuff much less likely. And the commercial property sector is also going to come under pressure because of the hit to retail and hospitality. As well as the fact that, look, we're all working from home now. I'm in our lounge as we speak. So lots of big offices, big businesses will be reassessing how much office space they really need to have. Reserve banks coming to the party. They obviously couldn't cut the OCR as much as they might like to initially. Negative rates are a possibility next year, hopefully not. But here's quantitative easing. You can see we've made up for lost time. We were very late to the money printing party, but we went vertical. So essentially, relative to the size of the economy, we pretty much caught up with everything the Federal Reserve did in a decade in about 2 months. And we are forecasting that QE program to be expanded from 60 to 90 billion in August, just to make it absolutely clear to everyone that they've got this, that there's no point in taking them on. They're going to keep going. They will eventually hit some sort of limits, self-imposed limits, But nonetheless, basically, the more you intervene in markets, the more you break them. And so they've sort of suggested that about 50% of bonds is about as far as they would like to go. That's that 90 billion number, roughly. They can also start buying other stuff. But if you start going down the lines of the Fed and buying junk bonds and going down like the Bank of Japan and buying equities and stuff, you really actually start blurring the line between the public and the private sector, let alone the line between monetary and fiscal policy. So it's all...
Just a quick question on that. The size and extent of the stimulus relative to the GFC has been quite extraordinary. How does our stimulus packages over the last few months compare to what the rest of the world is doing? And particularly looking back into the GFC context, what's the relative scale we've got here, globally and historically?
Yeah, enormous. I can't put a precise number on it, but essentially the budget was about 10 times bigger than it would have been without COVID. So obviously massive, and it has government debt going to 54, I think, % of GDP, and we'd see upside risk to that because we think they're a bit optimistic about how rapidly the unemployment rate will come back. The Australian fiscal package, I think, is even larger than ours, has a lot of things in common with ours, including the wage subsidy program. They've introduced a few new things like cash for people who decide to renovate their house or build a new one, that sort of thing. But keeping people in jobs and tiding firms through lockdown has been a very common theme, and that's just unbelievably expensive. The initial round of wage subsidies expires, I think, this week, and then they've expanded it by a further 8 weeks. They've put the bar a little higher, but they were going to make it, you had to have a 50% revenue reduction. Now they've made it 40%. As opposed to the original 30. So a lot more firms will still qualify for a second round of that. So clearly the government is very worried about what's going to happen to employment when that rolls off. But at some point we're going to have to face up to that because it's costing billions and billions. And we cannot and should not try and put the economy into stasis anyway. It has to adapt and evolve a new reality. And there will be winners and losers. And we obviously have to look after the losers and help them adapt. But we can't try to save every job, and we wouldn't be doing ourselves any favours if we did.
So Sharon, just a quick question from Shane actually in the audience. What are the most difficult things for you to forecast when making growth and employment forecasts?
Well, the Trans-Tasman bubble was a tricky one. The vaccine's another one. So, yeah, two things that really aren't economics, actually. So those are huge variables. Then the exchange rate's always completely impossible to forecast, but it's a big problem for the Reserve Bank. You know, we normally take it as given that when there's a huge negative global shock, our exchange rate trades as a risk proxy and goes through the floor, and that delivers a huge easing in monetary conditions. Not this time, and the reason is, well, we beat COVID, so we're in a better position than everyone else. Our commodity prices are holding up, so our currency is going north, and that is a pretty significant tightening. For those of you who have Bloomberg, it's quite fun to chart the MCI, not that we talk about that anymore, but it's done the most spectacular U. So that's pretty unhelpful, and it does mean the Reserve Bank's going to have to keep their foot flat to the floor for a while yet, I think. But no problem stimulating financial markets anyway. The equities here, you can see a bunch of different countries rebased, and New Zealand stands out for tracking the US market actually remarkably closely. This doesn't include the overnight move, but essentially we're back where we started. And that is, of course, the theme of today's seminar. So I'll just leave that chart there to speak for itself. Oh, there's a few slightly sarcastic comments on the slide there.
So Sharon, a lot of risks have been introduced to the economy. Stimulus is creating issues for us. I'd like to just pause there, maybe turn to Andrew Bascand, who is going to spend a little bit of time, if that's okay, talking about what's going on in markets and why potentially we've seen this this fairly bleak economic scenario that Sharon's painted, yet the stock markets have continued to rally, and the NZX, I think today, is back to its December 2019 levels. So you've lost a couple of months, but you haven't lost much more than that. And year to date, I think for the full year, I think it's ahead. So Andrew.
Well, thanks, and thanks, Alister, and thanks to the other panelists. Thanks for the invitation today. Yeah, well, I guess my purpose here today is clearly to talk about that decoupling phase, where equities perform best when the economic data is the worst. and additionally tell you that markets are really forward-looking. And that really is the clue to why there's a perception that equities are disconnected from the economy, but I'll argue, well, actually they're not right now. And the key context is, this is a health crisis so far, and it might develop yet into an economic or financial crisis, but at the moment it's a health crisis we're solving. And if we go back even 2 months ago, we thought it was going to be a lot worse. The infection and fatality rate we learned out of Wuhan in Italy could have been 3.5–4%. In fact, we now know it's more likely to be something like 0.35 to 0.4%. In fact, 10 times less than we thought it might be. We've been very successful, of course, in flattening the curve, and we moved on from that to actually in New Zealand go for elimination or eradication. And as a result, we're coming out of lockdown, so the economic data gets better. Of course, what we don't know is what's going to happen to the shape of the recovery. And I think the data we're seeing that Sharon talked about looks currently more like this partial recovery, certainly not really that L-shaped recovery that we thought it would look like back in March or April. Anyway, markets were pricing in basically no recovery back in March and April, and we've gathered evidence on that recovery. And you can see me now, you can hear me now, Alister, you can see the slides, just checking in. Yep, good. And so yeah, we've got some evidence that's a bit different to the evidence we're seeing in maybe broader economies, but China's an example, first in, first out, still dealing with waves, but we can see here this very broad Chinese production economic recovery index, which they continued to publish up until the end of April. We haven't got May data, but the Chinese economy got back to 90% of where it was prior to COVID. So that partial recovery evidenced. More recently, markets have been gearing off. What's happening is people come out of lockdown and they deliver themselves some optimism with respect to getting out and about again. And this Chinese services PMI was a bit of a positive shock for markets in the last week. It actually hit a 5-year high of 55. In other words, Chinese people getting out and spending money again, not just on goods, but on services. So as Sharon said, what's happening in New Zealand, there's some evidence that electricity demand is that V shape, and we're seeing some evidence in heavy traffic volumes as we've moved through level 3 and level 2. That we're getting this V-shaped recovery in some sectors. The issue, of course, is, as Sharon indicated, there's a couple of sectors where we're not going to get that V-shaped recovery whilst we have closed borders. So Z energy fuel demand, we're seeing light traffic and general local traffic going, but no aviation fuel here really, and no marine fuel as well because those cruise ships aren't coming. So net arrivals very important, and not just net arrivals generally for tourism. I think Sharon's going to mention later, we have an education sector that's very important as an employer and providing services sector GDP. So the key question for me in thinking about markets is how long can the stimulus continue and how long can interest rates stay very low? Because when I'm forward looking and thinking about markets, not only do I have to worry about the economy and earnings, but how do I value those earnings? And the valuation of earnings is critically geared around the level of interest rates. So this output gap is something that's going to be very important for markets to consider. History is never the most perfect guide to what's going to happen to earnings, but when we look back over the last 12 key either depressions or recessions in the global economy, we can see that generally it takes 10 quarters for earnings to get back to that previous peak level. Now, what if this time it takes 12 quarters, say 3 years? Well, that's quite possible. And so markets are forward looking. They will look through a void and think about the most likely scenarios. And one of them is we get back toward peak earnings. Indeed, the consensus at the moment probably is a bit too optimistic. It has us getting back well inside those 10 quarters for both New Zealand and America. So when we do our work in trying to bridge the void and think about anchors for the other side, there are many different valuation measures we can use. One is called the equity risk premium, where we compare future earnings with the equity risk premium, which is principally made up, of course, of a variable called a long-term bond plus a market risk premium. If we assume that earnings only get back to 90% of that peak level, then in our view, with a level of bond yields much lower than where they were, equities actually still look fairly good value, even after the pulse we've seen, the 30% recovery we've seen. And that's because the fall in interest rates is a greater force than the expected fall in earnings. And the break even for me is somewhere between this 20% to 10% fall in earnings. At a 20% fall in earnings, the data on the page here shows I'm more equivocal about the longer term valuation of markets. So I'll stop there and very happy to move to the real practitioner, the boardrooms, because the key question for me, Alister, is not so much this big broad view, but what's going to change? What will the recovery look like? What are we going to accelerate? Which are the sectors that will win? Which are the sectors that are going to lose? I think that's a more important question for investors. Thanks.
So from your point of view, you're 2 to 3 years out, as long as interest rates stay low. If interest rates don't stay low, and they could spike, and if they spike early, then it's all bets off and things change.
If the central banks lose control of that long end of the curve, if inflation appears, either or of those factors, then there is a significant issue naturally for all asset classes.
That's right, and we know Sharon's pretty keen to talk about inflation shortly. So maybe we'll turn to Rob Campbell. So Rob, it's a pretty tough time for businesses at the moment. We'll just get your video up if we can, Rob. Spotlight video. There we go, Rob. So pretty tough time for businesses at the moment in New Zealand, pretty tough time around the board table. How are businesses being led and governed through this time?
Well, as the first person I've heard be sympathetic about the situation around the board table, so thank you for that, Alister. Look, it hasn't been an easy period, and I don't think it's going to be easy for most businesses going forward. But just to pick up from where Andrew left off, really, it is different for different businesses. We do have some businesses who are, not terribly exposed to conditions in New Zealand, and businesses which are continuing to trade very well going forward. So not every business is in the same situation, obviously. At the moment, the overwhelming atmosphere around most board tables, though, is weathering the storm and trying to make some judgments as to the next 6 or 12 months. Around the board table, we try hard not to be overly distracted by what's happening on, for example, the equity markets, regard those as an outcome rather than something that you should be trying to track and respond to week by week or day by day. But nevertheless, you do have to have some regard to them. So companies are looking at their balance sheets, they're looking at their cash, harder than they probably ever have done before. They're trying to make realistic calculations about what they can achieve in the next 6 to 12 months. And by and large, from my experience, not just in my own businesses, but talking with fellow directors, by and large being very cautious about new investment and employment decisions in the light of those uncertainties. So that would suggest to you that being overly optimistic about the speed of recovery would be quite dangerous.
So just to sort of paraphrase that a little bit, there's been an element of short-termism, or at least the next 6 months, surviving the next 6 months, the focus around the board table at the moment, and it's very difficult to look beyond that. That's probably fair to say.
Yeah, look, I think that's inevitably the case when you get a crisis, whether it's a health or a financial crisis. When you get a total close down of the economy in the way we've had, I think it's natural. It's natural for people to focus pretty much on the immediate pressures. We're coming out of that period now, and all the boards with which I'm associated with and colleagues in other businesses are focusing on the road ahead, but it is the road ahead over the next 6 to 12 months.
So are there some key learnings that you can take from this period? Is there anything, Sharon's talked about this being a health-led crisis rather than a financial-led crisis. Andrew sort of talked about the similar things. Every single crisis we seem to go around the world is something different that causes it, and we should try to reflect and learn something from it. Is there anything specific that's sort of coming forward across the boards that you work with that, you know, this time's different and here's what we've learned from it and here's how we're going to apply it going forward?
Oh, look, one hears all these things about how the world's going to totally reset, and you know, everyone's had time to reflect and we're all going to be better people. It's a bit of a New Year's resolution theory, and I think it has about the same level of longevity. The natural tendency of businesses in these situations is to stabilise if we can, and then to try to get back some forward momentum. But you're inevitably more cautious than you were before. But the idea that we're going to totally reset our economy and our objectives, I don't really see any sign of at all. There's no evidence in history that people do that, and I don't see any evidence around the board tables I'm at today.
Okay, great. Well, I think it's a nice segue to talking a little bit more specifically about some of the sectors that we're involved with that influence the New Zealand market. We've had a couple of questions from different people about tourism and airlines in particular. Maybe that's a good place to start with a general dialogue, general conversation with Sharon and Andrew and Rob. Tourism, education. Have there been any fundamental changes to those sectors? What's the outlook for them? Maybe we'll hit tourism first. Rob, do you want to have a crack at that one?
Well, thank you very much. Well, tourism stopped. It doesn't get much more dramatic than that. So far as tourism holdings concerned, without wanting to talk a stock particularly, people do need to realise that a very substantial part of our business is offshore. So particularly in the United States, for example, there's been a very sharp bounce back in domestic tourism, a very sharp bounce back in RV purchasing and rentals. So the market within the United States is actually quite strong for our business at the moment. Tourism out of Europe is not strong, but the domestic market is strong. In New Zealand, as we've now moved from the most restricted parts of the close down, there is an interest in tourism, but New Zealand is not a rich country. It doesn't generate the same kind of revenues that international tourism does. So that's still a very substantial downturn embedded in the New Zealand tourism industry for quite some period to come while the borders are closed. You know, we're not going to get out of this by buying ice creams off one another and going for a drive in the weekend. So that is going to be an ongoing issue, pretty much as it is within Australia.
So just
it's a long haul for tourism businesses really of any kind, in my opinion.
Okay, just wanted to flick to Sharon because she mentioned in her session that we've got to take away the cross-border tourism from our GDP forecast a little bit. Is opening the borders to Australia going to make a material difference on the outlook for the tourism sector in New Zealand?
Yes, it is. It is a very large. It's our largest single market. So if you're going to open up to one, then that is the one. Of course, it could make a massive difference to the economy in the wrong direction if we end up with a super spreader event. So I'm completely in favour of doing this very cautiously. But yeah, as I mentioned, we do have to be realistic about the state of the Australian consumer as well. They are also going to be pulling their heads in a pretty significant way. And they'll also be under pressure to travel domestically and support their local businesses as well.
Okay. Andrew, any comments on the tourism sector?
Look, I mean, as an investor in the sector, it's more difficult to look through and forward with any certainty. When we, assisted and recapitalised, Auckland Airport, you had to make certain assumptions regarding when would get out of level 3, when we get out of level 2, when domestic flights would continue. And at that time, 6 or 7 weeks ago, we were actually pretty pessimistic in hindsight regarding how soon we'd move to level 3, let alone level 2, let alone level 1. And so we have some flights beginning in New Zealand, and that's a better position than we were 6 weeks ago. Unfortunately, for a lot of the tourist operators, they're quite high fixed cost businesses, and they've been geared on a much higher revenue stream. So there's a lot of adjustment ahead, and this is where I think clearly a lot of the pain is going to be felt. And it's incredibly difficult to predict how quickly we will solve the issue of opening our borders. My personal opinion is I'm a little bit more optimistic than many, because when I look overseas, there are more technology solutions available to engage in contact tracing, engage in higher levels of testing and better testing. So, I mean, I think it's doable. We just can't quite see our way through yet to having any certainty in this sector in the near term, but we have to be investors, so we take cognizance of, in 1, 2, 3 years time, what level are we going to get back to, and share prices certainly don't reflect a full bounce back yet of tourism.
Yeah, perhaps I could add, Alister, I don't want to sound too pessimistic about tourism as a place to be active as a business or to be invested. There's going to be a tremendous shakeout here. That is already happening. So businesses are falling by the wayside, and there will be M&A opportunities for those businesses that have good business models and good balance sheets and good leadership. So it's actually a pretty exciting period from an investment point of view in tourism, but the sector is going to be tough. That's the point I'd like to make.
Okay, specific question for you, Rob. Something that's been a little bit in the press lately. Responsible investment it was on the mind of boards pre-COVID crisis. There was a lot of focus on the green economy, impact investing. Do you think that's still in the forefront of directors around board tables?
Yes, I don't think there's been an enormous change in that. There is, I think, particularly around New Zealand board tables, the people involved actually tend to have quite strong social responsibility ethos. Anyway, that's not always the case in some overseas jurisdictions. The big institutional investors still have the same policies and aspirations. In an interesting way, I think the politicians might have abandoned sustainability, climate change and other things much more than businesses have. In every business I'm aware of, in the rebuild program, there is an embedded sustainability and social responsibility element that is still very strong. So quite contrary to what some out in the market might think, as I say, the ones who have abandoned it, at least in the short term, are much more politicians than business people.
Okay, just generally, if any of you want to take it, what would be the quantum of the offset in the tourism market? Again, a question from someone on the line. With Kiwis travelling internally rather than travelling overseas, how much of a difference is that going to make?
Well, it's about the same size. About the same size as international tourism, but of course it's just recycling money within the economy. International tourism was as big a foreign exchange earner as dairy. So, going to Hamilton for the weekend is not going to replace that. And also, a ski weekend in Queenstown is pretty expensive, and it's discretionary spending. So, if we are going into the type of recession that we predict with that sharp rise in unemployment, then once this flurry of helping out your local businesses and whatnot passes, people will they will prune their spending.
Okay. But if you do go to Hamilton, go and have a little play in the casino.
My perspective on this, Alister, is that there are certain thematics that are going to be in play. Millennial is going to be a bigger spender than the baby boomer in the next short time frame, and so what are they going to be thinking about? We can see from trends in spending really early on here that themes of my home is my castle, really important. Online shopping is really important. Healthcare, personal hygiene. We've all been through COVID now, but we want to stay healthy. The question for me, and back to sustainability, is will we still have this momentum in New Zealand amongst our millennials and Gen Zs for sustainable investing? And I don't think that's going away. I think that's going to be a greater theme. Will we sustain expenditure on domestic tourism? I think the answer there is the price has to be right. You know, we can't just all go to Queenstown and be paying global prices. There has to be a price adjustment.
Well, I remember when I was a kid, and that goes back quite a long way now, there was a marketing campaign, it must have been by the precursor for New Zealand tourism, saying don't leave home till you've seen your country. And that was one of the sort of the adages for those of us that are old enough to remember. Maybe that's the marketing campaign we are forced to employ at this point in time. Buy New Zealand.
There's a new one. Do something new, New Zealand.
Do something
That's
new.
the new tagline. Yeah.
Right.
Didn't stop you going on your OE though, Alister, did it?
It didn't, but I had seen a lot of New Zealand before I went on my OE, Rob. You're absolutely right. So there was a question about airlines before. We've seen some significant impact on Air New Zealand. They've been fairly open and upfront with what they're doing internally. We've seen failures of airlines around the world, globally. What's the general outlook for airlines? You know, from my point of view, it looks pretty pessimistic at this point in time. How long can they survive? How long can they hold out? Anybody want to field that one?
I suspect we're all going to want to avoid that question, because the airlines are at the sharp end of global travel, and it's not about to open up anywhere, and capacity is just huge. There's just very significant capacity. So once again, it's a question of how will that capacity be used? I think we're going to see innovation. So I think we're going to see more routes become established that will be point to point rather than hub and spoke. I think we're going to see airlines develop a greater differentiation in their offering. And at the end of the day, because they're fixed cost businesses, some of the cost structures just are going to have to change. It's a price elasticity of demand question again. So to get back to previous profitability, the cost structures would have to change very significantly, I would think.
Okay, so we've got a question from an anonymous attendee. I swear to God it wasn't me. It's very close to my heart. It's a question for Andrew and Sharon, and it actually is a nice segue into our next section, which is talking more about bonds, output gap and inflation. Betting against the Fed, ECB or the RBNZ has generally been a losing strategy. How much of the market recovery is about massive liquidity injection? Start up at 10. Start with Sharon.
All of it. Nearly all of it, I'd say. Yeah. No, there's still a belief out there that central banks are omnipotent, that they can solve any real problem with money magic. I'm a little skeptical. I think all this can kicking, we will eventually run out of road. If you run unsustainable government deficits and finance them through printing money, you eventually turn into Argentina. I don't know when that is, but you know, at some point, someone has to actually be allowed to lose some money when there's a huge negative, real shock. And that's an outrageous proposition, but I don't know. But maybe I'm a bit old-fashioned.
So are we all turning into Argentina then?
It's a race. It's a race to the bottom.
The race to the bottom. Andrew, any more
the only way we create real wealth is by, through technology, through pushing out that production possibility frontier and making productivity an important part of daily lives. At the moment, printing money doesn't do that, but it just gets us to the point of reallocating capital. And so we're being told very clearly, get your funds out of money markets and term deposits into the real economy. And then we throw it over to people like Rob to decide, well, actually, I'm through this phase of sustaining my company. I now have an opportunity to invest, and where am I going to invest? And then we get very micro. And it's the macroeconomics doesn't save us over 5 to 10 years. It saves us just putting a bridge over this void.
The bit we've done, Andrew, so far, both fiscally and from the point of view of monetary policy, is really the easy bit, isn't it?
Yes.
Is the spending. It's how you pull it off, how you slow it down, how you recognise that some assets are stranded, some are impaired, some are irrevocably impaired. We need to have that energising part of capitalism working that does replace what is not suitable with what will be suitable going forward. So no argument, from me at least, about doing the things that governments and central banks have done to date, but the hard work is pulling it off.
But we've been addicted to central government debt since LTCM in the late 90s, right? We've relied on our central banks to bail out companies and economies around the world. It's continued through the GFC. We saw the taper tantrum when they tried to ease back a little bit. Are we too far gone as an addict to easy, cheap central bank money? Sharon?
Well, there's no question that if interest rates return to anything like historical averages, an awful lot of governments and firms would be in huge trouble. So some countries are further down this path than others. Japan and the Euro area are stuffed with zombies. That's not the case in New Zealand and Australia, for example, but if we were to maintain interest rates at practically zero for a decade, then that's where we would end up too. So I think the government is aware that, you know, saving every firm and every job would be not only horrendously expensive but counterproductive, because we do need to allow the economy to evolve. But there's a massive bias in policy making, monetary policy or fiscal policy. The jobs you can see and save, you can count. The jobs that aren't created because the zombies are eating all the resources, that you can't see them. You can't see the lost productivity. And so that's just a constant challenge.
Okay. All right. Maybe, Sharon, on that happy note, we can move into a little bit of discussion about interest rates, inflation, and potentially the consequences for the housing market, because we've had a couple of questions come through on that. So, output gap, inflation, interest rates, where are we going from here? We have this huge amount of debt out there. How much more can we take? How long can we kick the can down the road for? What's it going to look like in a few years' time?
These are pretty big questions. No, I think, well, ever since the advent of inflation targeting in the late 80s, the output gap is the way we think about inflation, about whether demand is stronger or weaker than, you know, our ability to meet that demand. But of course, inflation in history hasn't only come about as a result of excess demand. The classic example is the 1970s oil shock, stagflation, the worst of all worlds, weak demand and high inflation. So it can happen. At the moment, it's really hard to see where that would come from. This is a massively deflationary shock. The oil price hit negative $38. It's now positive $38 roughly. So that's turned around quite fast. Food prices maybe in some, but that's really an issue for Africa and poorer nations rather than the developed nations. Food's just not a big enough part of the consumption basket. So it's really hard to see what would basically provide the match to set off the fire that would set all this money that's been printed that's sitting there in the basement, what would set it all on fire. But it's a really interesting thought experiment if something did kick off those inflation expectations and start that velocity of money, start that money spinning around and turn it into a hot potato, because man, it would blow fast. The central banks, the more money they printed to try and buy bonds to keep the long end down, the higher inflation expectations would go and the higher the long end would go, and then you'd start to question the solvency of governments and firms and build that risk premium in, and then poof, it would go super fast. And you know, as Andrew said, there would be nowhere to hide in that scenario.
Yeah, and that's where we have to differentiate our economy and maybe Australia's and maybe one or two others with economies that are pushing those government debt levels to, you know, to levels that are hard to come back from without a combination of inflation or debt relief. I mean, and that's typically in the long term how these situations get solved. And we look at New Zealand and Australia at the moment, I don't think we've pushed through those levels at this stage. We've been to these levels of public debt to GDP, you know, a number of times in the last 30 to 40 years. My fear, and we discussed this earlier in the week, is, you know, the extent to which we're pulling back from globalization for political reasons, geopolitical reasons, actually can start to put some sand into the works of global trade, and those production possibility frontiers we talked about, they can shrink a bit, and we can get some inflation through the system, which comes from, you know, inefficiencies. And that's a longer term story as well, but deflations in part come from globalization as well. So, you know, that's what we're looking at, but that's a long-term story, not to worry about, I think, in the next 6 months, but that's a long-term story.
So Sharon, question for you from Andrew Callagher. RBNZ is expanding its balance sheet at the moment. How and when does the RBNZ shrink its balance sheet?
That's going to be a really interesting question. They're going to face exactly the same issue that every other country that's done large-scale QE faces, and that is that people get addicted to it. The financial system becomes reliant on it, and when you try to withdraw it, you can get a very dramatic tightening in monetary conditions, much more dramatic than the easing in monetary conditions that you achieved on the way in. So that lies in front of us, but I would say they'll be very, very cautious about how they do that. And the Federal Reserve was making progress, but they just ran out of runway. Big economic shocks tend to come along about once a decade, and it seems to take a bit longer than that to unwind QE. So, well, longer than the second half of the cycle anyway. So it's going to be interesting.
Okay, I'm going to move through because I'm just conscious of time, and I'd like to turn to Rob again here, and maybe Aaron as well, Andrew and Sharon commenting as well. Have we got the right tool set for around the board table? Where will boards and CEOs invest marginal capital? If they're borrowing heavily, what's the impact on the cheap debt on boards around and companies around New Zealand?
Well, public company boards are by and large looking to improve their balance sheets in this situation because equity is available as perhaps not as easy as debt, but nevertheless there is equity available, and businesses are looking generally to improve their balance sheets. I think that's the right sort of relatively cautious thing to do. Look. This sounds awful about my colleagues, but by and large, the sorts of people who get appointed to public company boards are status quo managers or governors. They haven't got there usually because of their capabilities for radical thought and innovation. There are obviously exceptions. I'm not one, I hasten to say. I'm not a radical innovator either. But if I look around board tables generally, they tend to be quite backward or present looking at best, and I think that we're going to have to find a way when you have to restructure your business, and that's happening while the industry and the economy around you is being restructured. I think it does place some rather different demands on the board as to what skills and capabilities it has, and it probably also is true that senior executive teams in many cases we need to have a hard look at those as well and say, this was the team we needed for the market that we had before and the opportunity set we had before, and we should have a good hard look at both our boards and senior executive teams to see whether they're fit for purpose in this environment. We won't do it easily. It's just not what we do in public company land, but it really should be done. And I hope it will be done in many more of our businesses.
Andrew, any comments on?
I mean, the key here, in my opinion, is building the next really relevant global company from New Zealand. We've got A2, Fisher & Paykel Healthcare, Xero. We want to assist boards have the skill set to move beyond just doing local business, because we want large, addressable markets where New Zealanders with their innovation, capability, skill set can win. Likely these are in the IT healthcare sectors. We've got many companies with market caps of $500 million. Let's make them 10 billion, as we have with Xero, Fisher & Paykel Healthcare, and A2. Additionally, we need to play into those 15 to 20 million people urbanizing each year in the whole of Asia. And New Zealand has the skill set and the capability to provide consumer staples into those sectors and experiences for those people going forward. We can build these big relevant companies. We've done it a few times. We need to do it multiple times. And Sharon, that's the way we actually start developing real wealth for Kiwis, in my opinion.
So we had a question earlier on, and I sort of dismissed it relatively quickly, but I'll come back to it because we've, and this might be relevant to Rob, we've relied on the urbanisation of Asia as part of our tourism strategy, the wealth and the rise to middle class or the affluent, the wealthy society in China and Asia, sorry, my words are getting tangled here, coming into and across the border as tourists spending hard-earned dollars locally. Do we see that continuing, Rob? When, how? I mean, the virus is still continuing. It is rampant in some areas. How long is it going to be before the border opens and we can expect some tourist dollars coming back into the country?
I think that's driven by events offshore rather than here. I'm sure I know there's a willingness to open here when it's safe to open and when people want to open to us. So it's really, to a large extent, out of our hands. I don't think we want to anticipate that happening too quickly. So I think tourism businesses have to look at the adaptations they have to make for a largely domestic, perhaps trans-Tasman market in the first instance. My own view is that it will come back. The desire for, and all the survey information that we're looking at globally says that people will still want to travel. New Zealand will still be a desirable destination, perhaps even enhanced from some points of view if we can maintain our current health status. So it's a matter of us having the right structure in place for our tourism industry to efficiently take advantage of that.
Okay.
That's the challenge.
Okay, I'm just conscious of time. We've got about 7 minutes left on the scheduled webinar. We haven't really talked about housing. Sharon, maybe you could hit this one. Interest in a question from Bevan Wallace: the medium-term prospect of higher interest rates and higher taxes would appear to be heavily discounted. If and when would you expect the market to address how the fiscal stimulus is to be financed? I'm also curious about the impact on consumer mortgage rates too.
There's a lot of big moving parts for the housing market at the moment. Lowest mortgage rates ever, but migration outlook extremely uncertain. But basically, it's pretty clear that the immigration minister basically said today that hire New Zealanders, and if you're here on a work visa, we're not going to give you a variation, so you might as well think about your options and jump on a plane out of here. And then of course you've also got all the Airbnb housing that at least temporarily is being released onto the housing market. So places like Queenstown have flipped from desperate shortages to oversupply overnight. And then you add on to that the unemployment rate, which we see going much higher than it did in the GFC, and that will basically cause price discovery and end that standoff between buyers and sellers about what the house is worth. So we do see the house prices falling 10 to 15%. I guess if you can fix your mortgage for up to 5 years, then anything that beyond that, I don't think New Zealanders think much beyond next week in their financial planning. So that's forever. But it is an interesting question about what would happen to the housing market if inflation took off, but house prices would take off too, but your debt would be eviscerated. So in the 1970s, for example, there was a 20% fall in real house prices, but it was kind of painless, relatively speaking, because inflation ate up your debt as well, the savers who took the hit. Whereas a 20% fall in a low inflation environment, that's a real problem. Then you've got a massive proportion of people underwater on their debt. So I don't know when this whole Ricardian equivalence thing's going to kick in and people start to worry about higher taxes. It's certainly not a debate that Labour is going to be wanting to have in an election year. And even National, they're not going to be in a huge hurry to point out which taxes they're going to raise either. So I think we're just going to ignore that problem for now and talk about it another day. And the fact that our government debt starting point was so low, it means we can defer that decision a while, but the slower you go, the bigger the mess, really, in terms of fiscal positioning.
Okay,
Alister, I think with housing, you've got to be a little bit careful with your generalisations. Different types of housing in different localities are not perfect substitutes for one another. If you look at it through the lens of my Somerset holdings in the retirement industry, we worry a lot about housing prices because people sell a house to come in to our villages, but they tend not to be selling an inner city one-bedroom apartment. They tend to move into a retirement home. They tend not to be selling a new house out in a fringe suburb to move into a retirement home. So there are different parts of the industry, the housing industry, which respond in quite different ways. And I think under this period of stress, we're going to find that even within big cities like Auckland, very different patterns emerging. So there will be impacts. It does flow on to some extent, but they're not perfect substitutes.
Okay, I've done a very poor job of managing time. We were supposed to end up with a bit of time for each person to speak. I'd like to have that if we could. We may run a little bit over. I hope that's not a problem hugely for anyone. But the consensus of the day is, this has been a health-led crisis that's resulted in some massive fiscal and monetary stimulus, both in New Zealand and globally. There's been about 9 trillion New Zealand dollars of fiscal and monetary stimulus, which is about 3 times the extent that was deployed in the global financial crisis. Andrew's talked up why markets have responded to that. Sharon's also spoken about the economic consequences of all that debt. I'd like to start with Andrew as the optimist. Andrew, give us a quick synopsis of your thoughts on where we're going from here.
Okay.
Sharon, as the so-called pessimist in the trio today.
Sorry, Andrew, we couldn't hear you. Yeah, not that we don't want to hear you, you seem to be stuck on mute there. Okay, I'd say, well, firstly, the uncertainty is enormous. So anyone who tells you with any certainty about where they know where the economy is going, or the exchange rate, or equities is talking their book, probably. It's just extreme. But I do suspect that equities are pricing all the upside and turning a blind eye to some of the downside scenarios. It is a very risky world out there, and yet central banks with their monetary morphine have succeeded in utterly compressing all pricing of risk, as far as I can tell. And that's been the story of the last decade, but at some point that needs to unwind.
Okay. Andrew, have we got some sound for you back again? I'll have to say that's a no. Sorry about that, Andrew. We'll move across to Rob. Couple of concluding thoughts.
Well, look, my concluding thought is that shit happens, and in world history, economic history, it happens quite frequently. We're lucky that the pandemic is an example of that, but we're lucky it's happened in a country which has got a lot of natural advantages. It's got a stable and pretty competent system of government, stable institutions, and stable health resources. So our opportunity to deal with this particular event, I think, is right up there with anywhere in the world. We're hugely better than most, and so everyone involved in business and finance should be constructive about it. Is probably more important than whether you're optimistic or pessimistic. Be constructive about the opportunities.
Okay. All right. Thanks very much. Have we got some sound from Mr. Bascand? No, we haven't. That gives me the last word, which is something I'm very pleased about. So I just wanted to conclude with thanking everyone for attending today, thanking those people that took time out of their day to dial into the webinar that the CFA Society's hosted. I think our panellists have been fantastic giving their views. I think it's very hard to get to some concrete conclusions on the scenario that we're in at the moment. But I think it's an interesting path forward from here. I think we're lucky. I listened to a comment that Elon Musk made about the actual virus itself, where the infection rate has been fairly low, and we've gotten away pretty luckily with this actually not killing that many people around the world. And it's almost been a practice scenario for how bad things could get. We're dealing with the economic consequences coming forward, but from the humanitarian side and the health side, we in New Zealand have done a particularly good job. We're conscious that other countries are looking at us to see what we're doing, but we've got a bit of a path to tread yet. So with that, I'm going to end the webinar. Sorry I haven't addressed everyone's questions. There was a lot that was coming through. I've tried to cover as much broad topics as I could. Thanks very much. Thank you for the CFA Society. Thank you, presenters.